the AI bubble. We would be in quite the recession if it were not for AI. I think AI completely saved the stock market. It's kind of like Paul investing $100 in John, who invests $100 in Bob, who invests $100 in Paul.
The AI bubble popping. You might have been watching your stocks today and wondering that.
The threat of a bubble.
An AI bubble burst.
Reality check could be coming for AI valuations.
Another day of tech.
What if I told you a $25 trillion debt bubble was about to burst? And even worse, that every investor in the world owns these stocks.
A massive artificial intelligence company just released a memo in the background for nobody to see that suggests they face near certain insolvency unless they get bailed out from other players in the AI space. In this video, we're going to break down exactly what was just revealed in this filing. We're going to talk about the circular nature of artificial intelligence, which we've talked about before, but we're going to update it with this filing that was just released. We're also going to link it to what's going on with NVIDIA. NVIDIA just announced massively more efficient Rubin chips. And we also have a lot to say about the high bandwidth memory cycle, which is related to Rubin, but also makes the very problem about potential AI insolvency worse. Then we'll finish by talking about what just happened with Elon Musk, because he told us that one thing was false, and it only turned out to be substantially more true than he let on. We'll talk about all of it in this video. So hey everyone, meet Kevin here. First things first, we gotta analyze the cycle, the CoreWeave cycle. Yes, CoreWeave just released an 8K, and CoreWeave is really interesting because, as we know, CoreWeave, much like other AI data center plays, whether it's Iron, NBIS, Oracle, whatever, we know that companies like CoreWeave receive investor money from people who, want to make money from artificial intelligence. CoreWeave goes and buys artificial intelligence chips like NVIDIA chips or CPUs from AMD or otherwise, which of course are reliant heavily, even more so now thanks to an increase in inference demand in high bandwidth memory. And then of course time goes on, because everybody knows construction and a clock are basically synonymous because it always takes longer than we expect. Then we get data centers, and hopefully eventually we get money, and then hopefully eventually we could repeat the cycle. This is, kind of just a happy data center cycle. It really shouldn't even be called the CoreWeave cycle, but there's a little bit of a problem. See, this chart right here is the chart of Oracle's credit default swaps, which a lot of people track Oracle because they see it as a safer version of CoreWeave. And so if Oracle is sneezing, then CoreWeave must really be having problems. But anyway, back when we had this spike over here in the price of credit default swaps, basically insurance against the collapse of Oracle, we were at the highest level since 2008. Those have since spiked up to about 155, settling down into the low 140s, but then recently ticking up again, and I suspect they'll tick up even more tomorrow. Why? Because of a filing that just came out from CoreWeave, and it's not my favorite kind of filing. These 8Ks from CoreWeave are pretty glorious at telling us that there's probably a fire cooking somewhere and nobody wants to talk about it right now. Everybody's just closing doors around the house and like, well, no smoking here. What are you talking about? We're good. We're not good. Okay, so take a look at this. Entry into a material definitive agreement. Basically, CoreWeave here is telling you, hey, y'all, we got some debt. We might have a lot of debt. In fact, our weighted, average interest is somewhere around 10%. So we spend a massive amount of money on interest. We'll actually go through the financials in just a moment. And we just want to let everybody know that this new set of debt that we entered into in the summer of 2025, called our DDTL, double D, 3.0 credit agreement, is actually now being revised. And here's how we're revising that agreement. So we got together with all these different banks, including MUFG and US banks, and we decided that, we're gonna actually reduce and change a few things. The first thing that we're going to do is we're going to reduce the minimum cash that we need to, or are required to have on hand, to just $100 million. In other words, we need the cash for other things. You'll see in just a moment what those other things are, but they're basically saying, we need some more cash. Now, they're arguing that this is just to sort of align with the timing of deliveries because there have been some construction delays. But what's interesting is we actually go a little deeper here. We're also now going to postpone the initial testing date of the DSCR, which is basically a ratio that says, hey, like, how much money are you guys making compared to how much debt you have? And the banks are basically saying, hey, you know what? We're just gonna go monkey see no evil until Halloween of 2027, okay? We just don't even wanna look at the financials. So here's another 18 months, go F off, please just keep paying the bills, please, we trust you, bro. That's essentially what the banks are saying here on billions of dollars, mind you. Gotta keep the Ponzi going somehow. But anyway, then they're also going to postpone their initial testing. So like, hey, you know, before we go like do a deep dive on these numbers, can we just like see how many of your contracts you're actually fulfilling? So rather than dividing like total revenue and debt into each other to get a DSCR, they're going, hey, how many of your contracts are actually working out? And the bankers are basically saying, yeah, you know what? Before we even take a look at your contracts, why don't we delay that to February 28th? We're just going to close our eyes on that one too. And if for whatever reason we end up looking on February 28th, and if for whatever reason y'all still suck and y'all still can't get your act together, you know, we'll just turn a blind eye to any equity partner giving you guys a money injection, and if they inject money, we'll just say monkey see no evil. That's just what we'll say. Folks, they literally wrote it. They wrote it right here. The First Amendment also permits, you can't make this up, an unlimited number of equity cures for any failure to satisfy the debt service coverage ratio and contract realization ratio covenants prior to October 2026. So in other words, as long as Daddy Jensen Huang from NVIDIA comes around and gives you a bailout, we don't give two F's that you're violating the covenants of the billions of dollars of debt we lent you because Daddy Jensen's bailing you out. In doing this, to some extent, some people actually look at this with a really bearish lens, and they're like, oh my gosh, even the bankers realize if they don't put up the sort of balloon and like, hey, Jensen, can you get ready to bail us out? The bankers might not get repaid. But that's a jaded view. You know, why do we want to be really jaded about an unlimited right to cure violations in your loan terms? You know, it would be crazy to be jaded about that. I mean, come on. NVIDIA has basically agreed to buy $6.3 billion of CoreWeave's unused data center capacity. So like, if NVIDIA has this agreement to buy $6.3 billion of unused data center capacity, which CoreWeave has already asked NVIDIA to do, by the way, on some of their unused data center capacity, which is odd, because it's sort of like, how does CoreWeave have unused data center capacity and they're still building a bunch? More on what they're building in just a moment. Spoiler alert, like 30% of their assets are not even built yet. That's a lot of money. That's like $6.9 billion of money that's just sort of like in the construction process that's not going anywhere. But yeah, I mean, like to actually get NVIDIA to fulfill the rest of the purchases, CoreWeave has to finish building. See, that's all has to do with this material services agreement, which I have on the screenshot right here. This is the agreement, an agreement that was made on April 10th for an initial value of $6.3 billion. It's basically NVIDIA guaranteeing that they'll buy unused compute from CoreWeave to try to help get CoreWeave a head start. So Daddy Jensen's already bailing them out on one hand, once the stuff is built. But now the bankers are basically saying, hey, we know Daddy Jensen's gonna bail you out once your stuff is built. Can you also get Daddy Jensen to maybe like start hinting that he might have to bail you out before the stuff is built because you guys are falling behind? Yeah. That's not good. Now I know a lot of us are like, Bar Kevin, SanDisk, and Micron are going to the moon. Correct, they are, and their numbers are great. We've done a lot of analysis on them in the Meet Kevin membership. You could see that in the stocks tab. In the courses, we did an analysis on Bloom Energy this morning as well, which was phenomenal. They've actually got a really good balance sheet. This is it. And, you know, when you jump in over on the right side, you can see all of our different analysis, whether it's on CoreWeave or we did SanDisk or Micron or whatever. I mean, SanDisk, frankly, has a fortress balance sheet and massive cash flow. But more on them in just a moment. Like, I know people are like, Kevin, how could this be bad? Like, memory is doing so well. Okay, spoiler alert. There's something called a cycle, and it is all built out via innings. I'm gonna explain all of this on the screen in just a moment, but I'll point out exactly where we are and how this works in just a moment. But first, we have to understand the actual numbers at CoreWeave because I want you to actually see what they're facing. See, versus what they're telling us. CoreWeave is telling us, guys, everything is fine. I'm going to pull it up here. We're only blaming the weather. In their last earnings call, if you went through their last earnings call, you'd see that they're just blaming the weather. It rained a lot in Texas. And because of that, here we go. We got a roughly, heavy rains and winds caused a roughly 60-day delay in a city north of Dallas, preventing contractors from pouring concrete. So, hey, come on, guys. We just need a little bit more time and everything will be fine. That's the idea here, is CoreWeave's trying to tell us everything's fine. But when we actually look at their financials, we start facing, let's just say, some red flags. So first that we should look at right here is their cash flow statement. And what we're going to find is that their free cash flow is negative $1.6 billion per quarter. If you subtract this out and divide it by 3, you get the quarterly number since it's 9 months. Basically, we are bleeding $500 million every single month. $500 million every month, $4.75 billion over 9 months, and these are based on September financials. Now, if you actually subtract out depreciation off of this, you'd be losing another $167 million per month. So we're blowing a lot of freaking money here. Obviously, the cash flow situation sucks. But where do we sit in a debt situation? Well, that doesn't look good either. See, when we look at their cash flows, we can see that they've raised $7.5 billion of debt. And their repayments are somewhere around 2.9. So their net borrowings here were just about 4.75 or so, which happens to be exactly what they need over a 9-month period. So they're borrowing because they need to, and then they had IPO proceeds in there as well. Fine, great. But what's the problem here? The problem is, to me, it's really a gamble on steroids. It's not like house hack, in my opinion. This is simple real estate where you're buying homes. Like, we don't have any debt on our houses or our land or whatever, because we got a little land we're developing as well. We're not buying homes on 30-year mortgages even, right? But let's say we were. Let's say we were buying houses in desirable areas people could buy up and live in and then rent out, right? Like, so we buy them, we fix them up, rent them out, people live in them. Great, 30-year mortgage, sustainable debt, right? They're buying chips in a desert. They're not even able to rent them out right now because 30% of their assets are sitting unused. And they're not using 30-year fixed rate mortgages. They're using very short-term debt. In fact, $1.667 billion that they owe is due right here in just 2.25 years. It's weird to say that March of 2028 is only in 2.25 years, but they have a 15% loan due in March of 2028 at $1.6 billion. They got another $5 billion right here due in August of 2023. These are massive numbers. That's just in 4.5 years. And they have to pay off all $14 billion of their debt in a 5-year window. Their blended rate, their blended interest rate is 10%. So no wonder they're blowing money. This is a problem. Now, how much cash do they actually have to be able to pay this debt? And this is where you should get nervous. So just like signpost for a moment, CoreWeave is saying, Daddy Jensen, please bail us out. We have a problem. Or we're going to. And they're going to their bankers because they're out of freaking money. They're insolvent, okay? Now I just showed you all the debt they have. How they're financing more debt because they're spending all this money. And they got a lot of debt coming due within the next 5 years. Okay, this is all gonna, by the way, relate to XAI, Jensen's Rubin chips, and high bandwidth memory, all right? We gotta explain this all properly. People are like, Kevin, why can't you do this in a 2-minute short video? And I'm like, I'm sorry. It's dense, it's a lot, but when you look at the actual facts, you're like, damn, I understand why it takes a hot minute to explain it all, because otherwise I'll fall asleep. I need somebody to wake me up while we talk about this crap. But it's also really interesting. I mean, at least in my opinion. I don't know, maybe I'm just nerding out about this, but let's look at their balance sheet, right? So they got a lot of bills to pay. We know that. But the question is, how much money do they have over the next year? I mean, I started the video out by saying they're essentially insolvent within the next 7 months. Why would I say that? Okay. Well, let's just use their own financial filings to show you why I would say that. Please, CoreWeave, don't sue me, bro. So, current liabilities. Bills that they have on their desk. So on their desk right now, they have bills that they have to pay of $7.9 billion. Okay? So imagine you had, I'll just use millions for an example. Imagine you had $7.9 million sitting on your desk right now in bills. And then I told you have another $10 million, in their case $10 billion, of debt to pay over, the next 5 years, okay? You'd probably be like, oh my gosh, Kevin, dude, what did I get myself into? And then, of course, the follow-up would be like, but Kevin, how much cash do I got? If I got to pay $7.9 billion, or $1 million in my case, of debt, how much cash do I got to pay it all? I could probably pay it all with cash, right? No. No. They only have $3.5 billion of cash and accounts receivable. That's assuming they get paid, okay? Assuming they actually get paid on all their receivables, which a lot of these companies are delaying when they're paying CoreWeave, just part of the agreements, like Microsoft and all these companies, they get to negotiate longer payment windows. So hopefully that cash shows up for CoreWeave. I was generous, and I assumed that they have $3.5 billion of cash by adding those two things together. And restricted cash is really cash that's already spent, likely on new products and stuff, right? So basically, if they're burning $500 million per month, and they have, $500 million per month, and they have $3.5 billion of cash, they first of all only have about 50 cents on the dollar of all the bills that they have to pay. That's a problem. You're way upside down. You're sweating bullets. And if I divide out $3.5 billion of cash by their cash flow, that 500 mil burn, I've got 7 months. That means by April, given that this is a September filing, by April, I'm out of money. Well, here we are in January begging the banks to not look at our numbers and please enable Daddy Jensen to bail us out. Like, this novel is writing itself. They are freaking bankrupt, basically. They're insolvent. I shouldn't say they're bankrupt. They're insolvent right now. Now, what could make it worse or better? I mean, isn't it good that we have new chips from, Jensen, Daddy Jensen coming out? No, that could actually make it worse. I'm going to explain that in just a moment. It gets ridiculous here. But first, understand that this is a company as well that has about 35% of their business. I said 30% earlier. It's actually about 35% of their business sitting idle. Now, why? Well, because a lot of this is sitting as construction in progress. Of that, they have about $2.5 billion in accrued purchases, part of their expenses, their liabilities, right? But they just haven't been able to turn on yet. So people say, oh, magically, as soon as they turn this 35% of the business on, they'll make oodles and boodles and oodles of money. But the problem with that is, if you look at the business and you actually take the depreciation expenses, they don't make money. And they spend way more money even when you add that depreciation back in. The cash flow statement shows us that because the cash flow statement already adjusts for net income. So if you jump over here, you take that net loss of $715 million, add back in depreciation, and then you go, oh, great, they actually got $1.5 billion in cash. Yeah, but they're spending 6.2. So even if you get that next 35% up and running and you go, increase your revenues by 35%. So maybe add, I don't know, another chunk of revenue here. Even if you doubled that, even if you doubled the net cash provided by operating activities, that'd still be upside down. And they'd still have massive debts coming due within the next 5 years. And they still have massive debt obligations due in the next year and a half, which is exactly why the bankers are like, oh my gosh, we have to not only bail out their revenues, which NVIDIA is already doing, we have to bail them out during the construction phase because they're literally complaining about heavy rains and winds delaying their projects, which might be true. But everybody knows construction gets delayed. The only people who bitch about it are people who got themselves too deep into their eyeballs in debt, and they have no choice but to complain about it, to beg other people and point the finger at other people. Okay? All right. Enough of that for a moment. Let's understand one last thing about their financials, and then let's get into the future here. So the last thing I want to show you about their financials is just how much money every single month goes to interest. Of their interest expense in a quarter, they've got about $310 million net going to interest, which means $100 million, more than $1 million every single day are going to debt, which sucks. So what's the big bet here? The bet here is obvious. Get the servers online, everything will be fine. We're just doing this paperwork to cushy over this big cash liquidity squeeze we have. Hence this credit default spike that we've had. Credit default swap spike. There, let's get the words right. Okay? That's why we've had this big spike over at Oracle. You're seeing similar things at CoreWeave as well. I'm using Oracle just to show what's called contagion. When all of a sudden you have an issue at CoreWeave, that contagion shows up at Oracle as well because Oracle's trying to compete with CoreWeave. And if CoreWeave's going to go bust, you're going to liquidate a lot of those assets at bargain basement prices, which then lowers potentially the actual asset value of those chips at companies like Iron, NBIS, and Oracle. Hence, contagion. Now, how is Daddy Jensen already trying to bail out the cycle, and what are these new chips that he's been talking about? Well, it turns out XAI just raised a Series E fundraise of $20 billion. Now, why this is very interesting is because when there were rumors about the Elon Musk raising $15 billion, and everybody's like, oh, they must be out of money, Elon Musk says, oh, that's false. But that's usually what he does. In fact, I talked about it on the channel. I go, Elon's gonna say it's false, and then he's gonna come out and be like, it was actually $16 billion. so joke's on you. We actually needed more money. and then it's like, wait, but who's the joke actually on? Because Reuters was correct. You were raising money. Elon denied it was a $10 billion round. Elon denied it was a $15 billion round. And now they're cheering, going, guys, everybody thought we were raising 15. We actually managed to raise $20 billion. And we were able to do it with NVIDIA as a strategic investor. Ah, yes. The famous NVIDIA strategic investor. Yes, this is how venture capital and private equity markets work. Okay, what people do is you get somebody, like, imagine this, okay? Imagine Cathie Wood bestows her holy arms and wings on HouseHack and says, I'm joining the board and I will take a position in the company. Doesn't disclose how much it is, just like NVIDIA. And then we're gonna raise money at $10 a share, 10x what we raised money at previously, because Cathie is the strategic investor. And then everybody's like, Cathie has a 5-year time horizon. Let's get in. It's kind of like that, except it's NVIDIA as a strategic investor. Now, don't get me wrong, I love Cathie. This isn't to make fun of Cathie. I'm just saying you take a big name and you anchor their name with a higher round, and that's how companies get valuations that grow and grow and grow and grow. You just get strategic investors. So, what does that enable? Well, Elon Musk, we know, is burning cash hand over fist. And so remember the beginning of the CoreWeave cycle? It's exactly the same for XAI. They're expected to burn $13 billion this year. So really what they did is they just fundraised, well, that was actually last year because we're in 26 now. So $13 billion last year. That might grow this year, how much they actually burn. And so what they really did is they just financed enough burn for this year. So they have enough money to get through this year, right? But remember the beginning of the cycle. I want you to remember how this cycle works, and then we're gonna show you the innings of the AI wave, all right? So here's how this works. The way this works is investors put money in, okay? That could be you buying CoreWeave stock or NBIS or Oracle or CoreWeave or whatever you want, right? That's you buying stock. That's, retired seniors and their hedge funds or whatever throwing money into this XAI round because everything Elon touches turns to gold, so throwing money in. As long as that money keeps coming in, we can keep buying NVIDIA chips and we can keep buying HBM. Time passes, the data centers eventually get built, and then hopefully we get money out in the application layer. That's how the cycle works. Now, remember the unlimited equity cures part? All of this works, and NVIDIA will probably keep bailing out CoreWeave at some point, no guarantee that they will, as long as money keeps coming into the cycle. So as long as the cycle keeps going, NVIDIA has the capacity to bail out CoreWeave. As soon as NVIDIA doesn't bail out CoreWeave, the bankers tighten the covenants, CoreWeave goes bankrupt, chip prices collapse, memory prices collapse, data center values collapse, and money stops coming in. The cycle stops very quickly. Okay, we already know that. It's just we're starting to see some early warning signs. So, is this so bearish that you have to go run out and sell everything? Well, no, because see, high bandwidth memory is technically now sold out through 2026. Now, why is high bandwidth memory so incredible? Well, a lot of it has to do with our current needs for inference. And that's where NVIDIA has this like gorgeous video right here, where they showcase what's inside of these racks, each of these being a little drawer. And inside you see the various different component chips. And all of these various different component chips carry what? Memory. See? Memory. DDR5, look at that, juicy memory. That's just the CPU, right? What about the GPU? We're gonna have memory over here. See, there it is. High bandwidth memory 4, right? Every chip. So when they make these chips, we need high bandwidth memory. Now, who's buying all this memory? A lot of it being the hyperscalers, Microsoft, Meta, Amazon, Google, and obviously now Elon's XAI. So we're obviously not at peak cycle because people keep buying these chips. But we are somewhere on a cycle. And see, rising high bandwidth memory costs, which are really good for companies like, what do we got here? SanDisk. You know, this is when we went through their financials. We go through fundamental analysis like every single day in the course member live stream. Remember, you can get lifetime access by going to meetkevin.com and getting that lifetime access to this fundamental analysis we do every single day. And even if you don't watch it, you could just click on our little tabs and look at my analysis that I've done. And I add to it every day the market is open. But look at this. Good cash balance sheet. Look at these numbers over here. 29.7% margins. Revenue's growing 22%. But listen to this, their operating income is 4 times the annualized Q3 EPS expectations. So they're exploding right now relative to what Wall Street even understands. It's remarkable. Now they've gotten a little bit puffy, okay? At 210, they were about 10% below what I thought would be a fair value for a high bandwidth memory company like SanDisk. The thing is, because of these sellout announcements, they actually moon way past that. Why? Because of momentum. So now we've gone to the point where we're certainly overvalued. We're trading at a 3 peg now, which is a bit more expensive than where it should be. Should probably be somewhere around 15, 20% lower. So there will be better entries in the future for stocks like this. And we did that analysis all the way back. I mean, at this point it was like months ago. But what matters now is where do we sit in the broader cycle? Because remember, rising HBM costs isn't actually great for the entire cycle. Why? Because it reduces margins at AI companies. The margins that are already tight on even CoreWeave installations or Oracle installations get even more tight when HBM memory goes to the moon in terms of pricing. And that's where I introduce what I call the AI CapEx cycle, okay? AI CapEx cycle. And where do we sit today? Well, let's analyze this together. So my opinion is that, and I think we all agree, this all started with the GPT moment. Okay, that's a basic one. That's like the first inning of the cycle. Then we get this infrastructure explosion. Where we tend to start curving out is usually in high bandwidth memory. High bandwidth memory is a lagging indicator. It is the last phase of the cycle to tend to bubble. That's why we're seeing the bubbling now. Now that doesn't mean we're at the end, we're at game over stage. In fact, I would argue we're probably over here at maybe here, the 7th inning. So that means there's still some room to go in this AI CapEx movement. JP Morgan says the biggest mistake somebody could make right now is sitting out the AI boom that's coming, not being worried about the bubble. Maybe they're right. Maybe they're just shilling their book. I don't know. But what always happens in history is that capital expenditures plummet and there's an infrastructure crash once we get to an oversupply. That's going to take out a lot of companies in the application level as well. Because if this happens, the red line happens, we'll see some kind of recessionary hit simultaneously, which will take out a lot of unprofitable technology companies. This is normal. Now, That debris will actually pave the way for the artificial intelligence survivors to actually start making money. And now you stop allocating money to all the junk companies and you allocate money to the survivors. That's the long-term future that we really all benefit from. And I believe that the AI application era is actually still right here. We're really early innings, like maybe second inning of that application level. Now, NVIDIA and Jensen suggest right now that we are seeing such massive benefits in Rubin technology. He just had a big presser at CES where he talks about Rubin should reduce the cost of tokens by 10x. But I want you to think about that for a moment. If you reduce the cost of tokens by 10x, who does that actually cost money, right? Like, who loses on that bet? Well, it's probably CoreWeave. Now, I'm not saying this because I've got like a bear position on CoreWeave. I don't have a bear position on CoreWeave. I don't really care. Like, if you're in CoreWeave, I'm not trying to dump on CoreWeave, okay? The point is, Rubin chips that cost 10x less per chip, basically, or per token, rather, and need 4 times fewer GPUs to train parts of models. This is per Jensen. What you're really doing is you're saying all of that money that you just spent on CapEx up here at this top of the cycle may have been wasted on those older chips because the next generation chips are going to kick your butt. Notice how even after that 7th inning though, because remember, if I think we're right here at the 7th inning, you still have HBM. That's gonna keep going and memeing for a hot minute probably because these Rubins are gonna need a lot of high bandwidth memory. But the point is, more chip innovation is actually mega deflationary for rental rates from CoreWeave. This is why NVIDIA can actually laugh its way to the bank. Any lowering of energy costs or increases in efficiency make NVIDIA sell more chips, even to people they've already sold chips to, because they're like, hey, why are you using those old chips? They're costing you more money. You may as well use these new chips that we have. So really, NVIDIA is like saying, hey, get with the program here. Buy all the new junk and you too will be good. Okay, great. That's really bad though for, again, CoreWeave. Because if CoreWeave invested in all the H100s or early Blackwell chips, well then you got some big problems. You got some big pooper doopers coming. And nobody wants a big poopy doopy. Now, the hope is that LLMs and AI keep progressing. And as a result of the continued progress, we'll continue to need even the old technology, the H100s or older chips that are still being used today. And that's a great hope as long as investors are patient with the profitability cycle and obviously until we get to peak. So my take, we're probably in the 7th inning, late cycle of the LLM stage, but we're actually quite early on the application era. This is where I get excited when NVIDIA tells us they're open sourcing Alpamayo 1, their self-driving thinking and reasoning model. I actually think that the NVIDIA FSD, I'm gonna call it, just full self-driving, just to make it a little bit more, palatable or understandable or comparable to Tesla here. I actually think it is their most undervalued asset. I actually think that almost alone, once they transition from 89% of their revenues coming from GPUs, but instead they start moving to like full self-driving licensing or whatever, especially since they take in all sorts of traditional sensors, LiDAR sensors, as well as vision-based sensors. The fact that their models consolidated all of that, I think makes them one of the most, or makes this one of the most underappreciated assets at NVIDIA. And so I actually think not only is NVIDIA playing the infrastructure build-out game, but they're playing the application era. Now that's exactly why, in my opinion, they bought Grok. Not to be confused with Grok, the Twitter or X AI bot, but rather the language processing unit model company. That company that makes or designs those chips is now has been bought by NVIDIA for, roughly licensed out for $20 billion. It's technically not a complete buyout, but it's practically that. We made a separate video on that. But anyway, NVIDIA is riding both of these curves. NVIDIA will be a survivor when this crash comes. We all know that CapEx plummet is coming. And it's a red flag where CoreWeave is showing us, where things sit right now. I mean, Amazon's seeing it as well. People at Amazon are complaining that Amazon relies on Anthropic LLMs too much and they should have their own proprietary LLMs. But I think that's because Amazon knows you don't want to blow all your money on LLMs because they're going to be a commodity. And as soon as this cycle peaks out, it's the actual productive uses of AI that are going to make people real money. Now, what's my bias in all of this, just to be clear, because I don't have like calls or shorts on like NVIDIA or CoreWeave or whatever. My biases in all of this is I am seeing the real profits from our application layer. Now, we just raised over $10 million for our startup in just the last 3 weeks, which is insane, the amount that's come in, because people want to invest in that next cycle. Like, these are our fundraise stats for the last 3-ish months here, and you could see it on screen here. 1/4 October, 1/7 November. About 99% of this is fundraising. Then we announced the closing of the fundraise in December, which we're still closing it out. Like, we stopped telling people it's open, but like people applied even as of December 31st, and they have to get approved by a broker dealer. Like, there's a lot of SEC compliance involved and stuff. So people are still getting their approval emails, and that's how we've gotten like $3.4 additional million coming in January. And what we're doing is we're building on that application layer, which I think is the future. I got to update the website because this has already been released. We released this as promised in December, but the app's already out, which is great. And now we're in the improvement phase and the new iteration phase, which is really exciting. But people are buying this, and they're buying the lifetime access to it, which everybody keeps telling me is a bad idea, that I should be doing monthly recurring revenue. But for now, you can still get lifetime access to it. And you can get that at househack.com or reinvest.co. But that's my bias in it, is real estate SaaS. You can read more about it by going to househack.com. I think it's a net worth sniping tool. I did a video the other day where I saw a deal that was like model match listed for $500,000 less than what a comp was listed for. Same exact model. And I'm like, this is incredible. You're literally sniping net worth with this kind of AI. Now, obviously, you got to go renovate it, and there's work to do, and there's risk with every investment. But we're very excited about that application layer because we think even if AI gets no better than it is today, the AI boom can keep going. I just think it shifts away from that hardware stack and goes straight into software. That's my opinion. I'm just being transparent about the journey. If you found this helpful or any of this information helpful, consider sharing the video, consider subscribing, and we'll see you in the next one. Goodbye and goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.